Hey, hello, and welcome everybody to today's workshop. My name is Jason J. Hamilton, Certified Financial Planner, and the founder of Keep It Simple Financial Planning. Today I have some really cool things to share with you that hopefully can put some extra dollars into your pocket when it comes to saving taxes. I don't think anybody here would like to pay more taxes to the IRS. Am I right? So if you do, let me know in the comments, but I doubt anybody wants to pay more. So I want to talk to you today about 6 really smart things to do before the end of the year. But before we get into that, there have been some updates and some announcements about Social Security earnings limits and things like that for 2020. So I want to cover those with you quickly. And other than that, we'll get right into our tax planning moves today. So I hope you're having a wonderful weekend. And if this is your first time here, then every Sunday at 2 p.m. Pacific time, 5 p.m. Eastern time, we're going to bring you a workshop on something that's going to help you get one step closer to retirement, or maybe a couple steps, to closer to a confident retirement, because that's what I want for you. Okay, we're here in this group and this page. We're all about proper financial planning, thinking ahead, and having a good plan in place for the future. So I'm hoping this is coming through. Last week we had some big debacle. I did our whole workshop and it just wasn't broadcasting the whole time. So I had a bunch of angry comments. So it looks like it's coming through. I see Kelly here saying she loves the Sunday Talks. Perfect. That means it's live. Perfect. So I want to jump right in today to talk a little bit about some of the things that are updating here with Social Security. So let's just jump right into that. Let me share my screen with you here. Just a quick moment. Because there have been some updates, some good, some bad, right? So it just depends on what stage you are currently in, whether it's going to be good or bad for you. So let's bring this up here, and it looks like it is coming through on my side, so that's a good sign, and perfect. Okay, so what I want to talk to you about today is some of the updates here coming for 2020. Cost of living adjustment for Social Security is a whopping 1.6%. Right? I think last year was about 2.8. So, generally over time, it's going to average out to somewhere between 2 to 2.5. So, it's not great. Okay. It's something, in all honesty, it might be eaten up by any sort of Medicare increases if you're paying for Medicare. But hey, you know what? It's better than nothing. And there's plenty of annuities out there that don't pay you any increase over time. So I still am a big fan of maximizing your Social Security so that you can have an increased benefit each year. Again, if we're getting somewhere in 2.5% territory over time, not bad. But 1.6% is probably not going to change your life. Might help you buy a couple packs of gum or something. Hey, it is what it is. So, but there are some things here I think that are important. The maximum taxable earnings. Okay, so for you high earners out there that are earning, above the $100,000 income, you are going to potentially be paying more Social Security tax this year. As you can see here, it has gone from $132,900 in maximum taxable earnings to $137,700. So that's about $5,000 more dollars that can be taxed, a little bit less. So you can expect about another $500 of your actual money that's going to be going into Social Security. So I'm really sorry about that. I got to pay it. You got to pay it. But once you get past that, then there's no more Social Security taxation. But there is Medicare, right? So Medicare is unlimited, so you have to be careful of that. And then for a quarter of coverage, okay? So for those of you that don't know, how you qualify for a Social Security benefit is you need a certain number of quarters of coverage, and it's 40 quarters of work, okay? So it's 10 years, 40 quarters, and the quarter of coverage earnings has now gone up to $1,410, and that's from the previous $1,360. So that's gone up just a little bit. And so what you need to qualify for any sort of Social Security benefit is 40 quarters over your lifetime, and now it's $1,410 per quarter that you need to earn. So not a huge amount of money, but it is something to be considerate of. And then, as you may or may not know, your Social Security benefit is going to be determined by your top 35 years of earnings, or you can say 420 months, however you want to look at it. So if you continue working beyond your retirement age, beyond full retirement age, things will be adjusted upwards as you are earning higher annual amounts than you did in previous years. Your lowest earning year will be dropped off, and then the new earning year will replace that. So if you continue to work beyond, 67, 70, things like that, you can increase your Social Security benefit by earning more money than you did in your lowest earning year. So that is a slight update. And then the retirement earning test exemption amount. So this is important for many people, okay? So if you're taking your Social Security benefit before the year you hit full retirement age, okay? So if you're taking it at 62, 63, 64, 65, for some of you, it would be 66 if you have a 67-year-old full retirement age, but a lot of people are still in the 66-year-old range. Now, if you have up to $18,240 that you can earn without losing any of your Social Security benefit. A lot of people don't like when I say losing, so hopefully, you take this in the way I mean it. I don't mean by losing necessarily. I just mean that you will, in a short term, you will have a slight decrease that essentially you will get back over time, okay? So if you earn, starting in 2020 and beyond, over $18,240 per year, $1 in benefits will be withheld for every $2 of earnings above that limit. Okay, so if you're getting a Social Security check of, $1,500 a month, for every $2 you earn over $18,240, you'll be losing $1. So if you earn $2 over that, it would be $1,499. If you earn $4 over that, it'd be $1,498, and so forth. So it is a short-term decrease, and you will essentially have your benefit adjusted over time so that you will get that back down the road. But it sometimes can take many, many years. So if you are taking Social Security at 62 and you continue working and you're making, $50,000, $60,000 a year, and you lose most if not all of your benefit, it might take you 10, 15, or 20 years to see all of that benefit back. So that's why I say lose it, but it technically is just withheld for now and then readjusted down the road, okay? So, and then the year you reach full retirement age, okay? The year you reach full retirement age, you can earn quite a bit more without having to worry about having any of the benefit withheld or losing it, whatever you want to call it. From 2019 to 2020, it's increased just under $2,000. So it's gone from $46,920 per year, or $3,910 per month, to $48,600 per year, or $4,050 per month. So what happens here is $1 in benefits will be withheld for every $3 in earnings above the limit, and that's the year you turn full retirement age. So once you hit full retirement age, whatever your age is, then there's beginning of the month there, like it says, there's no more benefit withheld. Okay, so that's only a short-term amount that's withheld. So those are things I wanted to be aware of, because those are new updates that have come since the last couple of weeks, and that'll be going into 2020 here. Okay, so hopefully that is beneficial for you. Now I would like to talk about a couple things here. Let me see something here. I think my microphone here may have gotten unplugged. Hopefully it didn't, but if you guys can hear me, just let me know, because it looks like to me it's unplugged, but hopefully it's all right. Now I want to talk about 6 planning moves that you should be considering before the end of the year, okay? So for those of you that like to save money on taxes, this is for you, okay? So hopefully you enjoy this. We are going to talk about some things here around taxes, but before we do, I have to let you know that everything I'm going to speak about today should not be considered financial advice. It should not be considered unique to your particular situation. You should definitely consult with a tax professional before making any of these moves I talk about today, because you do not want to make a mistake and have this come yell at me, okay? Because what I'm trying to do here is give you good information, but this should not be construed as financial advice, legal advice, tax advice, or anything of that sort, okay? So let's just jump right in here. So the first thing I want to talk to you about is considering tax loss harvesting, okay? You may or may not have ever heard of tax loss harvesting, okay? So I'm going to try to make it as simple as I possibly can. But what tax loss harvesting is, essentially, is if you have some assets that have gone up and some assets that have gone down, if you sell the assets that have gone up and the ones that have gone down, and you net out your gains minus your losses, whatever's left over there, if you've held both those assets over a year, will generally be considered a long-term capital gain. If it is held less than a year, it'll generally be considered a short-term capital gain. So when you're looking at managing your portfolio, and this is for money that is not in retirement accounts like IRAs, 401ks, things like that. If this is for money that is in taxable accounts, so you can say, maybe if you had stocks, mutual funds, index funds, things like that, that are in an account that are not inside of a retirement account. But tax loss harvesting can be very, very powerful, and it can be a great way for you to actually keep more of your money by doing some of these moves, either throughout the year or even towards the end of the year. Okay, so some things to be thinking about are in 2019, stock and bond markets have seen ups and downs, right? We've seen quite a bit of volatility lately, but this is normal, okay? It's normal, and it's part of the process of investing for higher long-term returns. If you don't want any volatility, then you're going to put your money in something like a CD or a savings account. You're going to get lower returns for that, but you won't have to deal with any volatility. For most people, they are going to be putting at least a portion of their money into investments which will experience some volatility. If you have money that's outside of retirement accounts, then you can look into something called tax loss harvesting. So what you really want to be looking at is if you have any assets that have fallen in value, okay, you may be able to sell those assets and swap for gains in other assets with losses in other investments, or up to the $3,000 capital loss allowed against other income. So if you didn't know, you're allowed to take up to a $3,000 capital loss per year against other income. So if you have some sort of capital loss that qualifies here, then you can actually reduce that off of your income annually and potentially pay less taxes on that. And then if you can also do things like if you have one mutual fund that's pretty similar to another mutual fund, but not so similar that they are the exact same, you can sell one, buy the other one when the market's down, take your loss, and essentially move your money over to another very similar fund. That's what we do for clients. We have multiple backup funds that are close enough. They're close enough, but they're not so close that the SEC will say that they're so similar. So we can use those to swap out because you do not want to be buying and selling within the same 30-day period. You can't qualify if the funds are too similar. But if you have two different funds that one went up, one went down, you can sell them both and swap the gains in one for the losses in others, and then net out your gains there. Okay, so that's called tax loss harvesting. And the great thing is, even if you can't use those losses this year, you can actually carry these forward, right? So currently you can carry them forward forever pretty much. So, if you do this work this year, even if you can't use them because maybe your income's too low, whatever it may be, or you're not paying any tax, for example, you can just keep those to the side and you can carry those forward to a future year where you may have larger gains. So really smart thing to do on a regular basis. And again, this is something we're doing constantly for clients that we work with here, okay? All right, so next thing is you can make an IRA contribution, okay? So a lot of folks, honestly, I know a lot of you folks do put money into an IRA, but many people don't. Many people just put money only in their 401k, and that's all they really do for savings. And if you didn't know, you can put up to $6,000 in an IRA for 2019 and an additional $1,000 catch-up contribution if you're over 50. So that's a total of $7,000, and that's actually for each spouse, okay? So if you're married and let's say one member of the family is working and the other member of the family is not working, you can still do a spousal IRA for that other person, and you could put away up to an additional $7,000 for that person. So you have to be careful here, because if you have a workplace plan like a 401k or 403b, you will have limits on a traditional IRA that are relatively low. I think it's about 70-something thousand. I don't have that handy. Don't quote me on that. But you can still contribute to a Roth IRA up to nearly 200,000. I think it's at 193 to 203 is sort of the cutoff for Roth IRA contributions. Okay. And even if you're over that income, you can still do a non-deductible IRA contribution. Can't take the tax deduction this year, but then you can convert that, do something called a backdoor IRA and convert that immediately to Roth. Okay, so like I said here, consider a spousal IRA to stash away more if you've already maxed out your contribution. And then consider utilizing a Roth IRA. I think Roth IRAs are still pretty underutilized. I know a lot of people know about them, but they're still pretty underutilized in the scheme of things. And, I talk to a lot of people, and I still see a lot of people not contributing to Roth IRAs, even though it does make sense, right? So if your tax brackets are lower now than you're expecting in retirement, then you really want to consider a Roth IRA. If your taxes will be higher in retirement, if your taxes this year will be higher than in retirement, then you want to consider a traditional IRA. There's also some finagling there depending on how you're going to be needing to withdraw funds, but the general wisdom is tax brackets lower today, Roth IRA. Tax brackets higher today than retirement, traditional IRA. Okay, but if you are retired but have lower income now than you will have later in retirement, then you may also want to consider converting pre-tax retirement accounts to Roth accounts. Okay, so I'm going to talk about this more later in another step, but that's something called a partial Roth conversion or a Roth conversion. Okay, so these are tax planning moves that can be very, very beneficial if you do them properly. Okay, so again, make sure you're talking with a tax professional or someone that knows what they're doing if you're not sure if you're going to be doing the right thing here. Here's another thing that I think a lot of people, as they're getting closer to retirement, are missing out on. You really want to adjust your 401k or 403b contributions for the year so that you can max out your account without giving up any employer match. I know there's a lot of people out there that are, living on a really tight budgets because they're trying to put as much as they possibly can into their 401k or 403b, and it's getting close to that time of year where, depending on your income, overtime, bonuses, things like that, you may be plus or minus getting to that maximum. And so you want to take a look at your contributions at this point, since you have a couple months left, and figure out what do you need to do, increase those or decrease those, because you don't want to miss out on any employer match. If you fund your workplace retirement account too early, then you won't be able to put more in, and you may miss out on some match. So you want to watch out for that, okay? So 401ks or 403bs, very, very powerful retirement tools, and can really add a lot of enhanced security because the limits are much higher than IRA accounts. So for 2019, the 401k contribution limit is it's $19,000. Sorry, I missed a zero there, with a catch-up contribution of an additional $6,000 for individuals age 50 and up. Okay, so that's up to $25,000 you can put in of your money, not including the match, into all 401k or all workplace retirement plans you have together. So if you have two jobs, and let's say you have two 401ks at different jobs, the combination contribution that you can do is up to $25,000. So these limits apply on a combined basis for the traditional and Roth 401k. So you might have to speak to HR to this, but most accounts can be adjusted online. So you want to maybe pull out your most recent pay stub, look at your contributions, and make adjustments accordingly there. And by the way, I want to note down, if you have questions, go ahead and leave them now in the comments, and I'll address those at the end of our discussion here, okay? So here's another one, is reviewing your paycheck for proper withholdings. Many people just either put aside way too much money in taxes, so they're getting this massive tax return, $4,000, $5,000, $6,000, $7,000, $8,000, or they're not withholding enough, and so they're paying a big tax bill at the end of the year, right? Ideally, you would have basically a zero tax bill where you wouldn't owe anything and you wouldn't get anything back, because that means you had all your money and you did not give a loan to the IRS throughout the year. That's the ideal, but it's pretty tough to do. But I like to check in on paychecks this time of year to see should we be increasing withholdings, should we be lowering withholdings, and so something you might want to do. So by reviewing your paycheck for proper withholdings and doing a tax projection, you'll ensure that you are ready for tax time and you won't overpay too much or under withhold, for which there can be a penalty. So if you under withhold as well, there can be a penalty for this because the IRS wants their money and they may charge you a fee. And if you want to check on your paycheck, there's a good website here. You can go to irs.gov/individuals/tax withholding estimator, or just another tax program to check. Okay, so if you use something like TurboTax, something like that, you can check there as well. But if you're not meeting your expected tax burden, then you may want to consider adjusting your W-4. If you're pretty close, you can maybe pay a little tax or whatnot. But if you look like you're going to be massively under withholding, it's probably a good idea to adjust that today so that you don't have to come out of pocket when tax season comes or have to get on some sort of payment plan to pay the taxes back because you didn't plan properly. So October is a really, really good time to do this. So I'd recommend that for you, okay? All right, so now we are going to talk a little bit more about converting your traditional IRA to a Roth IRA, okay? So I know a lot of people think about doing this, and a lot of people do it wrong, okay? And a lot of people don't know what they're doing, to be honest with you. They just kind of guess, and they just pick a tax bracket and then hope it all works out. These are actually some pretty technical calculations, but if you do this can really help you out in many, many different ways, right? It can help you out by paying less taxes later down the road. It can help you out by lowering your required minimum distributions, which you'll have to pay after 70 and a half. And at the end of the day, it gives you more tax diversification so that as you are drawing from your accounts in retirement, you can have different buckets to pull from, okay? I love to have taxable, tax deferred, and tax-free buckets. Taxable will be, like I talked about, your like brokerage accounts. Tax deferred will be accounts like 401ks and traditional IRAs, and tax-free would be Roth 401ks and Roth IRAs. So by converting some of this money prior to RMDs, and even better, you can do it prior to when you take Social Security. So if you're thinking about taking Social Security and you're delaying that a little bit, then that's a good time to do it in those years between retirement and when you draw your Social Security benefit. Okay. Many people don't know, right, that there's actually no income limit for converting a traditional IRA to a Roth IRA. So the income limit for contributing to a Roth IRA, like I said, is like 193 to 203. That's where the cutoff is. So if you make above that, unfortunately, you can't directly contribute to a Roth IRA. You can do what's called a backdoor, but you can't directly contribute. But there is no limit to how much you could convert, okay? So does that mean you should convert all of your money that's in traditional accounts to Roth accounts? Absolutely not, okay? I see people asking questions like, you know, should I just start converting all my money over to Roth so that I don't have to pay any taxes down the road? And that tells me you don't really understand how to do this properly. So you really want to make sure that you're looking at this on an annual basis, year by year basis, and look at what your current tax brackets are expected to be, what your future tax brackets are expected to be, and then look at how much your income need is going to be. Because a third determining factor, and even if the current versus future tax brackets don't play out, is if your income need is much lower than your required minimum distributions are expected to be in the future, then it might be smart to just pay a little bit of tax today, because our tax rates are very, very low right now comparatively to the historical tax rates. And our current tax plan is set to revert or to sunset in 2025. So if you're going to be 70 and a half in 2025 or later, it might make sense for you to pay even a little bit more tax than you should today, because if the 12% go back to 15 and the 22 goes back to, I think, 24 or 25, you could be doing some smart things by planning for that today and setting yourself up for a nice tax situation in those later years of retirement, okay? So while it may not be the right choice for everybody, here's some reasons to consider doing so. Number one is capturing the benefit of tax rates that are lower due to the 2017's tax legislation, okay? Like I mentioned, 2025, things are going to reset, so you might want to take advantage of that while you can. Number two is being in a lower tax bracket than normal due to retirement or a low income year, okay? Number three is gaining the benefits of tax-free income in retirement or for a beneficiary, okay? So this could be really important, number three. There are some things that are being talked about right now where beneficiaries may not be able to do what's called a stretch IRA. So what that essentially means is when you have a beneficiary on your IRA accounts, currently you can, when those go to the person, they can choose to take that RMD or required minimum distribution based on their lifetime and the IRS's table for RMDs. So if they're a little bit younger, you used to be able to stretch these out for their lifetime basically. It may go away where you have that stretch IRA. There's some of this talk about some updates to Social Security and other things around these IRA distributions, and it may go from a lifetime to a 10-year window, okay? So let's say that you leave your IRA, whatever's left over, to a beneficiary. And let's say that beneficiary at that time is in their 50s or 60s, because that makes sense if you are, at the end of your existence here on this earth. Maybe you're 80 or 90, maybe your kids are 50 or 60, and they're probably in their highest earning years at that point. So if you leave them a traditional IRA, and one, tax rates reset, so taxes are much higher, plus on top of that, they may have state taxes to pay, and then on top of that, they may lose their stretch IRA, so they have to pay everything back in 10 years. You could be giving a whole bunch of money to the government that that you didn't have to if you would have planned early, okay? So this is why this could be a really, really powerful move, but you want to make sure, I'm going to repeat that, you want to make sure that you're doing the right thing for you and your individual situation. This is not a simple thing that everybody just needs to do. You really want to look at your case-by-case situation, okay? Number four is capturing the benefit of an unused AMT or alternative minimum tax credit carryover. Again, this doesn't apply to very many people, but it could be a benefit. Number five is capturing the benefit of a net operating loss carryover. Something to think about here. Again, this is something you may or may not be able to do. It's for a small portion of people. And then number 6 is the taxable portion of the conversion may be lower due to after-tax contributions made previously. Okay, so these are all things you want to think about when it comes to, or potential benefits, I should say, when it comes to doing a Roth conversion from your IRA traditional account to a Roth IRA account. So one big thing, okay, this is huge. You really want to make sure you're paying attention to this. You want to remember that Roth conversions are now permanent and cannot be recharacterized like they used to be in the past, okay? So previously, you could do a Roth conversion any time of the year, and if something changed in the market went down, you could always move it back to traditional, and since your shares were lower, you'd be able to actually move more shares over to the Roth in that conversion. But now it's kind of a one and done deal. So when I'm working with clients, I really look at October, November, December is when we're looking to do these particular moves. So please, please, please make sure you know what you're doing and be certain before you make a change, because you cannot go back at this point, okay? It could be a big, big mess for you. All right, and the next thing here, potential tax planning move, is looking at capturing any benefits you can from a 0% long-term capital gain rate, okay? So if you don't know, there's 3 capital gains rates, 0, 15, and 20, and they're all based on income, okay? So if you have income below $39,475 as a single filer, or $79,950 as a married filing jointly filer for the 2019 tax season, you may benefit from the 0% long-term capital gains rates, okay? So what this means is you can sell capital gains, so investments held more than a year, for any amount less than the gap between your regular income and these limits without getting taxed by the IRS. So this could be very, 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 very powerful if you have, let's say you have some old stock, like let's say you inherited some old, I don't know, AT&T stock or something, like there's some old Apple stock, and that was bought 20 or 30 years ago. And now you have a big chunk of capital gains in there. This could be an opportunity if you have lower income below these ranges here to sell off some of that and not have to pay any taxes on the gain in that stock, okay? So could be really, really beneficial, and this could be a lot of dollars in your pocket. Again, you want to make sure you're partnering with a qualified tax professional, or make sure you know what you're doing if you're doing it yourself. And I do want to remind you that this is on federal tax, and many states will still tax the gains, so be sure to speak, again, with a qualified tax professional. But the thing is, with state tax, it's a much smaller amount generally than federal tax, so this could still be very beneficial for you, but you may have to pay some state taxes, so just be prepared for that as you are getting ready to file for tax season, okay? And that's what I have for you today. If you would like to chat with me personally to talk with you about some potential tax planning moves for yourself, retirement planning, really anything when it comes to your financial planning world or wealth management, I'd be happy to chat with you. I do have very limited appointments available currently because I am quite busy, but if you'd like to schedule a time to talk, you can go to keepitsimplefinancial.com/talk, and there you will find my calendar, and you will be able to choose a time that works for you, okay? So these next couple months through the holiday season, end of year, I got very, very limited spots. So, but if you are interested and you're looking to speak with me and to discuss your retirement planning situation so that you can go into 2020 with a solid game plan, I would love to speak with you, okay? So I don't see any questions in the chat here. I'm going to take a look. But if you have questions, put them in the chat, and I'll stay on for a couple minutes. And if not, then that's okay, and we can wrap up for today. So let's see here. Yeah, I'm not seeing any questions. So hopefully you guys, you all enjoyed this workshop. Hopefully you found something of value that you can use for your particular situation. And if you need any help with anything around retirement, anything else, investments, things like that, I'd love to discuss that with you, and I'd be happy to help you out, or just at least talk with you, right? I think a lot of people just could really use somebody who's seen multiple situations before to help them wrap their brain around what's going on with retirement and really understand like all the different aspects, because sometimes when you're in your own planning situations and you've only looked at your own, right? You've probably not looked at 300 situations in the last 2 years like I have. I think these calls that we have can be really beneficial, and it doesn't necessarily mean we have to work together, but a lot of times I do end up working with people because they want the help, right? So I'm here to help if you want the help, but it's not a requirement, and the call is complimentary, okay? So if you enjoyed our discussion, let me know in the comments. I'd appreciate that. Leave a like. You can share this post. I'd love for you to share it with your friends or family that can benefit from this. And if you haven't followed my page yet, you can go to Jason J. Hamilton, CFP, and find that page. Follow it. We do these workshops every Sunday at 2 p.m. Pacific time, 5 p.m. Eastern time. And during the holiday season, I may take a day off, by the way. So I'm going to prepare you for that. If I cancel because I'm on holiday, that might come. But generally throughout the year, I'm going to do a workshop every single week. And other than that, have a great and wonderful week. I appreciate everybody that's watching today. It means a lot to me that you guys show up and you watch on a Sunday. I really do appreciate your time and attention. And I try to give you the best value that I possibly can and things that I think will really help you out. So if you have any ideas, questions, things you want me to talk about, you can leave those in the comments as well. But other than that, I'm going to wrap up for today. Have a wonderful weekend. I will talk to you soon, okay? Bye-bye now.